The U.S. Federal Reserve is set to scale back COVID-19 stimulus as a crucial policy meeting wraps up. Economists expect the central bank to taper its bond buying program, amounting to $120 billion per month. But the Fed has already signaled it will keep interest rates on hold near zero, despite growing inflation risks. Now, Nick Harper joins us live. Well, Nick, investors have long been preparing for that tapering, but are there growing worries that interest rate hikes are coming?
Well, there are, and that's certainly what you would expect, considering that inflation is as high as it is. It's currently hovering around a 13-year high at 5.4%. We haven't seen it this high since about 2008. Everything in the United States has gone up. Energy prices, the cost of food in supermarkets, essentially the cost of living has all increased. And the Federal Reserve would normally fight rising inflation by raising interest rates. That's one of the tools in their arsenal. But the Fed have said that the end of the bond buying program and the instant increase of interest rates are not connected. So we're not expecting to hear today from Jerome Powell that we will have interest rates rising instantly. However, there is this expectation that they will rise sooner than the Fed had initially signaled. They had said that there wouldn't be any increase to interest rates in the whole of next year in 2022. But there is now perhaps this expectation that they could rise 6 months earlier than expected. So in the middle of next year, potentially June or July, we might see the first interest rate rise. And traders, investors, the markets are already pricing that in, potentially as many as 2 to 3 interest rate rises during the course of next year. So we won't hear an instant announcement today, but there is that thinking that we could see rate rises coming quicker than expected.
So tighter monetary policy is on the cards at a time when the Biden administration is stumbling on its $1.75 trillion plan for the economy. So does that complicate the decision of the Fed?
Well, it shouldn't do. I mean, the Federal Reserve is meant to be independent politically. Whatever's happening at the White House, whoever is in the White House, Republican or Democrat, the Federal Reserve should be independent of that. But of course, yes, the Democrats are struggling to get those bills passed. That $1.75 trillion bill has climate change provisions in it, but it also has a huge amount of social reform provisions. So it's not linked in the Fed's mind, but for many Americans, we are likely to feel that link because we have the cost of living increasing. We have the possibility of interest rate rises just around the corner. That means higher mortgage repayments. And then the possibility that this social reform bill won't get passed. And those provisions include things like help with childcare costs, healthcare help, including drug pricing as well. So there could be this knock-on effect that while the Democrats are unable to get this bill through Congress, they may get hammered from voters. It's a huge motivating force if people are struggling financially. And with the midterms just a year away, they may look at the Democrats and the Biden administration and feel that perhaps change is needed to help the economy.
Well, thanks for that, Nick Harper, live in Washington, D.C.